Okay, this is part 2 of our elementary stock series. And this question is going to be, what is the stock market and how does it work?
What is the stock market?
And how does it work?
It's an exchange. Okay. I don't know I have to use analogies. eBay, right? What happens in eBay, right? They have listings of stuff. It's technically an exchange, like an auction exchange. It's the same thing in the stock market, right? If you look at it, it's where all the publicly listed shares, and it's each of its markets, right? You have the New York Stock Exchange, you have the NASDAQ, you have the American Exchange, whatnot. These are exchanges. These are where publicly traded companies are traded, right? So it's an auction, basically. So when you go in there, you'll see stock prices have a bid and an ask. That means if you want to buy it, this is the current price that everyone's bidding to buy it for. If you own shares and you want to sell it, that's the bid price, which is the lower price, which is what all people wanting to share are offering the stock for. So it's an exchange. It's actually an auction, and that's how they're traded. So how stock prices move is if everybody's buying a stock, people are like the old days. You watch TV, you see all these guys holding tickets up there. It's like, hey, I'll buy it at $20.22. Well, I'll buy it at $20, and I'll take some of that. I'll take some of this. It's like an auction, right? That drives the price of the stock. So if everybody buys the stock, it drives the price up because your demand goes up. If everybody starts selling, it's like economics. There's too much supply. What happens to the price? The price goes down. So that's how stock prices move, and that's how exchanges work. So you're just basically an exchange. You get listed, meaning you go through this whole rigorous process through regulatory and everything to take your company public. When you take your company public, like you see on TV, they ring the bell. Whenever a company goes public, they ring the bell when the market's closed. That's just like a thing. But that's basically a company being taken public, for example. And when they get taken public, like I think the one that people can remember is when Uber went public. It was a big deal, right? Because everybody knew what Uber was, but you couldn't trade the stock, right? So when it goes public, is the company basically offers a certain amount of shares that's authorized by the board to be traded publicly, right? So they go out to market saying, here's the IPO price. It's initial public offering price for so many shares. And that's what happens when a company gets taken public. It gets traded on the exchange, and then as time goes on, you're buying and selling the same shares basically, unless they issue more shares. So I don't know whether that's simple enough for people to understand. I'm kind of going too much detail now, but basically it's an exchange. The stock market's an exchange where companies can be traded between buyers and sellers. Shares of companies are traded between buyers and sellers, and that's it. Yeah.
Got it.